Good afternoon once again. This is our final presentation of the day. It's involved with trading tactics, where we're going to try and put together a lot of the stuff that we've been dealing with over the last day and a half and put it all into one presentation. When in our money management firm, when we're trying to sign up a new client, basically what we tell them is we're not trying to make them money. That's not our first objective. Our first objective is to maintain capital. Because the first objective, it has to be to maintain capital, because if you start losing money, it's much more difficult to come back. And this next slide, or I should say the number one trading rule then, is cut losses quickly and let profits run. And here's why. This example here shows you the starting capital of £100 or $100 on the left, and we make our first trade and we lose 50%. So the first trade has a 50% loss. Now, we're a little bit luckier on the second trade, because the second trade makes us 50%. So we lost 50% and we made 50%. So we should feel okay about that. Then the next three trades each make 10%. So we should feel good about that too. And so we lost 50% and we've now made 80%. But you know, the funny thing is, statistically speaking, we're only just about back to break even. So in other words, the point is, when you have a big loss, it takes a tremendous amount to come back from the big loss. If you lose 50%, you have to double your money again to get back to where you started. It's much more difficult to do that. So the advice, therefore, is, first thing to do is not to lose money. I mean, obviously, you are going to lose money, but keep those losses as small as possible. I think I'm going back on the slide here. So I will. It's a problem with pressing the wrong mouse button. So a key trading rule, then, is always run scared. And the number one decision when entering a trade is to know where you're going to get out if the market goes against you. That's the first decision you should make. Not how much money am I going to make, but if the market goes against you or against me, where is my stop point? Where am I going to get out? Because that's where my loss, that's the loss I have to take. So it means setting stops ahead of time and changing them when appropriate. And the best place to put stops is above resistance or below support. So what are support and resistance? We covered support and resistance a little bit yesterday. I'm going to take some time to maybe go over some of that ground today and expand on it. So if you recall from yesterday, I said that support is where a declining trend can be expected to halt temporarily due to a concentration in demand. And resistance is the opposite of that, where an advancing trend can be expected to halt temporarily due to a concentration of supply. So support and resistance areas, as you recall from yesterday, are not predictors of where market prices will reverse, but merely indicate possible or probable points where they could. And here's a diagram indicating how support and resistance might work. Previous lows, for example, are possible points of support. We draw a line there and we see another rally take place. Late rally, and then that support is violated, because just because we have a support level doesn't mean to say that it will stay there. Sooner or later, most support levels are violated. And the price then comes down, finds another low, which could potentially be another support level, because lows and highs are potential support and resistance levels. But in this case here, the price falls lower, and it moves down to C, where it will find support, and you can see the price is in a trading range now. And what's interesting is that as the price rallies, it finds resistance at the extended green line, which is now brown, at point B. So the point here then is that support reverses its role to resistance on the way back up. And if that's the case, then the line at A ought to act as resistance if this breakout from this above this brown trend line continues and we get a rally. So what we'll do is extend that line to the right and see what happens. And that's our potential resistance level. and the price does in fact find resistance at that level, and then eventually it moves through. But you notice when it moves through the resistance and experiences a decline, it finds support at what was formerly the resistance level. So the line at A on the way down is support, on the way up is resistance, and finally on the way down again becomes support. So resistance reverses its role to support on the way down, and up the price goes. So the rules for determining the significance of the support-resistance zone are: first, the more times the zone has been able to halt or reverse a price trend, the greater its significance, because that means that the more times you see that particular level, the more important it becomes as a psychological point on the charts. Number two, the steeper the price move preceding a given support or resistance zone, the greater its significance. Remember, yesterday I was giving the example of the door over here representing resistance. And if I was about 8 feet away, I could rush in and maybe I could crash through that door because I'm not very far away and I can come very fast to the door. If I start from that door over there, it's about 100 feet, 150 feet, and I go to the door, by the time I get to the door, I'm probably going to be exhausted. And I probably can't go through the door. But the door is the same resistance, whether I'm 6 feet away or 100 feet away. Same thing is true in the markets. If the resistance is at $10 and I try and go through resistance from 2 by zigzagging upwards and going through, that's going to be a tremendous resistance. But if the price is at say, $8 and tries to go to 10, then it's more likely to get through that $10 resistance. And finally, the more security that changes hand at a given level, the greater its potential significance as a support-resistance zone. Obviously, if a lot of people buy the stock at $10, they buy millions of shares at $10, the price comes down, when it comes back up to $10 again, what's going to happen? Human nature is that you want to break even, so they're going to start selling that stock. So it's going to be a much greater level of resistance if only a few 100,000 shares were bought at 10, because that couple of 100,000 could be easily taken out and the price move higher. So where are support and resistance points likely to develop? Well, first of all, previous highs and lows, as we've already discussed. And here's an example where the high could be a resistance level, and we can take this line and extend it to the side, and each time the price comes up, as you can see, it's finding resistance at that point. Then finally, the price works its way through, and you can see when the price comes back down and retraces some of that ground, that resistance level now reverses its role to one of support. Price continues to rise on up, and now we can see that that was a high point, and that's a potential resistance level if the price begins to rally again. So we can put a line across there as a potential resistance level, and sure enough, when the price then rallies back up to its old high, that becomes resistance, where it halts temporarily. The upper and lower area of gaps often represent crucial support resistance pivotal points. That's the second one. So here's Oracle, and you can see I've blacked that out with a blue, I've darkened it out with a blue square. I take that away and you can see there's a gap there, where the opening and closing points on gaps represent important potential support resistance points. So if I draw a line across there, the opening part of the gap, you can see that's where that particular decline stopped, almost right on there. And gaps are important because they're emotional points on the chart, and that's why they become important support resistance levels. Here's another example here of Comcast cable TV, and you can see there's a gap again, and the rally just didn't quite come up to that resistance level, but it was in the pretty close region of where the gap opened or started. So it was a good attempt to close the gap. As you recall, yesterday I said that when you see an emotional point on the chart like a gap, invariably these gaps are closed within a certain period. You can't say it's closed within 1 or 2 sessions, but usually within 2 or 3 weeks or less, depending on whether it's an intraday chart or so on, the gap is usually closed. But not all gaps are closed. One final example, there's another large gap there, and you look at the opening part of the gap, and that was where a good place to expect that rally to find resistance. Number 3, emotional points on charts. Gaps are emotional points on charts. But we were looking at other 1 and 2 bar patterns earlier today, and Here is an example of an emotional point on the chart where you have a kind of a false move down there, indicating a sharp move down, and the price opening and closing well off the low end of that trading range, so that of that bar. And the lower part of the bar, of course, represents an important emotional point, and that tends to be good for looking for support resistance points. Well, obviously, we can't look backwards in order to trade, but I just point this out that was an emotional point on the chart, and before that point, we had seen several rallies find resistance at that inflection point in the chart. So if we were at this chart and looking backwards, we'd say, okay, well, that emotional low, or an emotional point, is in fact a good point at which we should expect to see support, because it was previously one where we found resistance on 3 different occasions. Actually, it's 4 different occasions, because if you look very carefully, this little rally here was halted at that point there. So that becomes an important potential pivotal point on the chart. In this case, it would be a support because the price is up. Well, there is the 4th one. As luck would have it, in this particular instance, the price, once it got through that support level, really violently fell. But what about the next time it should rally? Well, let's take a look at that, and you can see that, in fact, the price did find resistance at that point there. So emotional points on charts where prices come down intraday or intrabar and then close up again tend to be, this point down here tends to be an important potential support or resistance level. And that's a good place to be, putting a stop below. Trend lines and moving averages represent potential support resistance zones. Because a trend line, as we discussed yesterday, is nothing more than a dynamic level of support and resistance. Usually we think of support, we think of it as a specific level on the chart, or resistance as a specific horizontal level, where a trend line is a dynamic level because it's going down or it's going up. So here we can join 2 points, and then we extend that trend line, and you can see that the price rallied up to that trend line on several occasions. If you extend the trend line down, we can see the same sort of thing happening here, where the trend line is acting as resistance. Moving averages, too, can act as support and resistance zones. And here's the 50-day moving average, that's the blue line there. And what I've done here is I've outlined points where the average has been an important support level, either on the upside or a resistance level on the upside or the downside. And it's occurred quite nicely in most of those situations. But there are, of course, some exceptions where the prices temporarily move through, as indicated in these boxes just here. So that's one of the other points I wanted to make, is that when you see a moving average, it again is a dynamic level, potential dynamic level of support or resistance, but it's not always going to work. It's a probable point where the price might reverse temporarily, but it's not a guaranteed point. Sometimes you have to integrate moving averages with trend lines and so forth, and here what I've done is we've got the price crossing above the blue 50-day moving average at this point just here, and then it breaks above this previous high. So you've got 2 pieces of evidence that the trend had changed, one when it breaks above the average, and one when it crosses above the moving average. The red line is a 200-day moving average, and you can see that that acted as important resistance during that period after that rally we just looked at. But it's also important to note that we can also draw a trend line going through the moving average. And just as yesterday we could draw 2 trend lines and say, one trend line is we'll say resistance, and you add another trend line to it that doubles the importance of the resistance, so you can draw a trend line as resistance and a moving average can become resistance, so they can reinforce each other as a level of resistance, provided, of course, that moving average is a reliable moving average, or is proved reliable in terms of that particular security. So the intersection of good trend lines and reliable moving averages represent massive potential support resistance zones. And if we've got a massive resistance zone and we want to go short, then obviously we put our stop above that resistance level. Finally, retracement points for previous moves are useful ideas for forecasting where we're going to get a support resistance zone. In classic technical analysis, people used to think that there were 3 good, important retracement places. The price comes down, it will find support or resistance in this case at a 33% retracement of the decline. In other words, the decline is 100. When it gets back up to 33, that could be resistance. Or if it gets up to 50% of that decline, it could be resistance. Or 2/3, because those are the usual retracement moves that people have calculated. Well, let's take a look at this in the marketplace. Here's a decline here from the top of that rally to the bottom, and that represents 100% of the move. And that line there, this line just here, represents a 50% retracement. So it's reasonable to look at these pivotal points in the future as a potential support resistance zone. In this case here, 50% became resistance, 50% of that 100% decline. Over here, it is almost 2/3. It's almost up to the 66% line. So whenever you see a sharp decline and you see a rally taking place, you're trying to figure out where that rally might end. Look at this analysis and say to yourself, well, where's the 33% retracement? Where's the 50? And where's the 2/3? It's not guaranteed to call a reversal, but it's an intelligent place to be expecting to see a reversal take place. Here's another decline just here, and you can see that initial rally stopped at the 50% level. And if you look at the 50% level and we cross over there, you can see that next decline was also a support level, because that's where so we have a resistance on the one hand and a support on the other. And then finally, on the 2/3 line, you can see how I'm drawing lines across here, not very straight in this particular case, but they acted as pivotal points. Initially as up here as support, then it was resistance, and the price is above it again as support just here, and then finally as it went below, acted as resistance. So these are all ways in which you can figure out that maybe there's a potential support resistance level by the retracement rules, by the previous highs and lows, emotional points in charts, gaps, trend lines, and moving averages. So the key places to set stops for long positions are below a previous low, below the extreme low of an emotional bar, below an uptrend line, below a reliable moving average, on a breakout from a price pattern, or better still, when more than one of these conditions is met. In other words, if you had resistance at a trend line and a moving average, that meets 2 points. And if that happens, one of those happens to intersect in a previous high, that gives you 3 points. Much better place to put a stop above. If you want to set stops for short positions, then you want to do it above a previous high, above the extreme high of an emotional bar, above a downtrend line, above a reliable moving average, on a breakout from a price pattern, or better still, when more than one of these conditions is met. Let's take a look at some examples in the marketplace. Here's the dollar-yen. This is a 10-minute bar, and you see the price breaks out above that trend line just there. So we buy on the breakout. And then we can draw an uptrend line just there, where they both get reinforced at around the breakout level. So we could also, if we're lucky, and we didn't buy on the breakout, when we get the pullback, so we could initially buy here, but if we get lucky, we may have ignored that and bought on the pullback just here, and then we can place our stop below the intersection of these two lines here, because the intersection of two lines obviously indicates an important support level. So we place the stop below the trend line, and in this particular case, we lose. We have to make our minds up that the market's not always going to do what we expect it to do. Sometimes it changes its mind, and what we have to do is then put the stop in ahead of time and limit our losses. And the price moves on a little bit, and we see a little bit of a trading range just there, and maybe we figure that the price is coming down and we should be going short, so we would sell below the support level, which is below that trend line. And where will we place our stop? Well, above a resistance level, which is the previous high. If we were lucky enough not to have sold there, but we waited and then got in, and then it still got bearish, when the price comes up towards this line was support, now it's resistance. And so we could go short just around this point here, using the resistance level, or the level above the resistance level, to put in our stop. And also, we can now draw a downtrend line, which has been touched 3 times, so it's a reasonable line. And the downtrend line, of course, by its very definition, is intersecting with this previous high, which is also intersected with this trend line. So that becomes a very important pivotal point on the chart, because it's a resistance level in 3 ways. 1, this downtrend line, 2, that previous high, and 3, this extended trend line. So we can lower our original stop now and put it, instead of putting it above this level here, we can now put it at that point just there. And as the price, luckily in this case, continues to move on down, we can lower the stop above the trend line and follow the trend line down. So as at the end of the chart, we would have our stop just a little bit above this line just here. Here we're looking at a moving average, and you can see with the ellipse here that we're getting a lot of whipsaw signals. So we're not looking at that moving average. You'd say, well, I want to go short, I want to go long. Let's say you want to go long during this period here, and you realize that you can't use the moving average as a point at which to go long and then cut out, because it will be stopped out when it went below the moving average. You can't use the moving average as a support resistance level, because obviously it's very unreliable during this trading range. So what you would do is you could say, well, okay, I would like to buy when it breaks above the moving average, but I want some more evidence. So what you could do is you could, in this particular instance, choose to fight the battle at that particular point where the trend line is violated on the upside and the moving average is also violated on the upside. You wouldn't have been able to do that in any of these whipsaw signals down here, but you could do it there. And that's one of the things I think is important about trading, is that most people seem to think they have to be involved in the market all the time. I say no. I say get involved in the market when you choose to get involved in the market. If you are a guerrilla fighting a warfare against a government army or something, you're going to choose the time and the place of that battle. When the army is in the valley and you're up on the cliffs and you can shoot down at them and you can stop them from going anywhere by blocking the entrance to the valley, that's what you're going to do. Same thing is true in the markets. You should be picking your times when you're going to fight. Pick them when the probabilities are in your favor. Let the market come to you. Don't go to the market. You don't have to be involved in trading all the time. You don't have to buy and sell on every signal. Go when the odds are strongly in your favor. So in this particular case, we've got 2 little bits of odds. We've got the moving average crossover and the trend line. And then over here, you can see that we can draw an uptrend line which finds itself intersecting with the moving average at that point just there. So that when the price breaks above that green trend line, it's possible to buy and then place the stop below support, which would be the intersection of this trend line and moving average and at that previous minor low. And as we move up, you see you can draw another secondary trend line which also intersects with the moving average. So you could be raising your price, you're raising your stop, I should say, as the price moves higher and as the moving average and the trend line move higher. There's an extreme point just there, and remember I was telling you extreme points represent important potential support resistance zones. So let's say, for example, that you found some reason to buy down here somewhere. I don't see one on the chart myself, but if I did, I would put the stop below this emotional point on the chart just here. And in this particular case, that point was never taken out, but we now have another one on the chart just here, another extreme point, and as we move on, we can draw a horizontal line at that point there. So let's suppose, for example, we bought somewhere in here. I see no reason why we would in terms of technical stuff, but let's suppose we found something as a 4-hour chart. Maybe we found some dramatic stuff on the hourly charts or the 30-minute charts. We could find a reason to enter it here. We will put our stop below this emotional point just here and below, and as we move this line across, of course, it reflects the same support level, same level. And you can see that the price comes back down again here, again indicating this is an important support level. And once again, and then finally a 4th time, it comes down or approaches that support level. So that became a very important emotional point in the chart, below which you would place your stop. Here's an example using the Australian dollar, and you can see that it's formed a head and shoulders top, and perhaps we would want to short that. Well, let's suppose that the market changed its mind and that this was a false breakout. Before we get into this trade, we have to make the decision. First decision we have to make is, where are we going to get out? And in this particular case, we have a nice trend line we could construct, and we could say if the price breaks above that trend line, then we'll get out at that point, because if this does prove to be it, we have no reason at this point to figure out this is going to be a false move. But if it is a false move, then we've already taken the action ahead of time, and we're limiting our losses. So what can happen here is you place our stop above the trend line, and you can see what happens. Price almost explodes. And one of the reasons it almost explodes is because this is a failed pattern. And here's the whipsaw break. And remember what I was saying yesterday, when you get a whipsaw break, the chances are you're going to have a dramatic move in the opposite direction to that indicated by the whipsaw. Whipsaw indicated down, the opposite direction is up. So very important to get in and figure out where you're going to get out, just in case the market goes against you. One of the, in Market Wizards, Jack Schwager lists some of the great characteristics of the great traders. And almost to a man, what these fellows do is they all mentally rehearse what's going to happen in the future. The reason being that when you get into the market, as soon as you commit money, emotion, you're also committing a lot of emotion. So what you've got to do is to try not to commit as much, well, you can try not to commit any emotion, but you're always going to have some, but minimize that emotion as much as possible. And one of the ways to do this is to get into a trade, before you get into the trade, say, where am I going to get out in case it's wrong? Just exactly what I was showing you here. And if that's the case, you've already mentally rehearsed where you're going to get out. So when it happens, it doesn't hurt so much. If you don't do that, the chances are that you're going to react slowly to what's going on. And let's suppose that there was some bad news that pushed the Australian dollar down just here. And then it turned out it was a rumor, or some good news came out, and immediately you're shell-shocked if you haven't got a plan about how to get out. But if you've already mentally rehearsed where you're going to get out and actually physically put your stop in the market, then you're going to get hurt, but you're only going to get a slap on the wrist instead of something far more serious. So very important to mentally rehearse what could go wrong, and if it does go wrong, what you're going to do about it. And then you're in a much better position to react if what you don't expect to happen actually happens. So then the price comes up, corrects a little bit here, and we may want to go short again here when it breaks below that brown line. And again, we have to decide where we're going to get out in case it's wrong, in case the market goes against us. Well, one place could be above the brown line, another place could be above the previous high. Well, obviously, above the previous high is a big, big risk to take if you're going to be shorting down here. So either you get away, and that's the best place to be doing it. So either you ignore the trade, or if you really feel bearish, then you would put the stop a little bit above that brown line, because if it comes above the brown line, that's not doing what you expected it to do. When it broke down, you expected it to go down, maybe rally up a little bit, touch the line, and then continue to go down. What you would not expect it to do is to come down and then go back above the brown line, because if it goes back above the brown line, it more or less invalidates the breakout. So what happens? Yeah, sure, it goes back above the brown line again. And so what you might say to yourself is, well, I ignored this breakdown here. Now I should be maybe thinking about going long, because what I'm seeing here is a possible base developing, and if the price breaks above there, it's going to be quite positive, especially as we now have we would then by then have a series of rising peaks and troughs. The price comes down again, and then it does in fact break to the upside there. Here's another example here where you see a nice base forming, and the price has a significant breakout on the upside. So maybe you decide that you want to go long here. If you're wrong, then you would put your stop below the previous low, below that support level, as marked by that brown line just there. So we follow on, and we can also see that that's a great place to put a stop, because we can also draw that blue trend line. So we've got two trend lines intersecting at that particular point. So it's a great place below which to place our stop, because it's a great support level. So what happens as things go on, I don't know if you can see this, but that is actually a 2-bar reversal. Here's the first bar right here, and the second bar opens towards the high and closes towards the low, and that is below our breakout point. So we got two pieces of negative evidence here. One is the false breakout, and with the close below the resistance level, and the second one is a 2-bar reversal. So at that point, we might want to get out of the situation because it's not giving us the probabilities of success that we originally thought we had when we saw the initial breakout, which looked, on the face of it, to be pretty strong. But if we stayed with it, we'd still have our stop in, and you can see that that stop would have significantly limited any of our losses that we'd placed. But we had actually mentally rehearsed all this stuff ahead of time, so we didn't have to worry when it went through the... We could be disappointed when it broke through the support level and got our stop, but we wouldn't have to worry about it. Here's another example. This time we're using the dollar yen, and you can see what we have here is a trend line with an exhaustion break. And the idea here is that the exhaustion break is a false break above this resistance level, and the price is unable to hold above the resistance level and then breaks down. And this right here would have been a good place to have gone short just below the line, because the exhaustion break is in effect emphasizing the significance, as I mentioned yesterday, of the trend line. Because a price that can rally through the trend line shows it's got some energy, but when it can't hold above that trend line, it's showing it really doesn't have as much energy as you originally thought. And usually when you get these whipsaws, you get, as I mentioned before, a strong move in the opposite direction to that suggested by the breakout. So in this case here, you go short and place the stock above the exhaustion high at that point just there. And then as the price works its way lower, you would lower the stop as the trend line gets lower or moves lower. I'd like to talk a little bit about using oscillators with intraday charts. A key problem in any trading situation is that we don't know which kind of trading environment we're going to experience. Sometimes we have a trending environment, sometimes we have a trading range environment, and we have to use different tools to adapt ourselves to different environments. If it's a trending, I should say, environment, then that means that we can use moving average crossovers as our points of reference. If it's a trading range market, the moving average is going to go straight through the trading range, so we can't use that. It's no good. So we have to use an oscillator, because an oscillator is best suited to a trading range market. And if it's a trending market, then the oscillator is going to take you out prematurely. The problem is that we don't know ahead of time whether we're going to go into a trading range market or an environment or a trending environment. So one solution is to take two units and split the trade into two parts. Liquidation of one part is triggered by a momentum signal, which is a trading range environment signal, and the other is liquidated with a trend following signal. So we sell one unit when the oscillator reaches an extreme reading and sell the other part when we get the moving average crossover. So we're sort of hedging our bets as to whether the future environment is going to be a trending or a trading range market. Now, if the oscillator never reaches an extreme, we'd sell both the units on the moving average crossover. So here's sort of how it would work. At the top, we've got the S&P with a 30-minute close and a moving average. And underneath, I've got a 30-period price oscillator. That's where we divide the price by a 30-period moving average. When the price is the same as the moving average, we get a reading of 0. And when the price is way above the moving average, we get an overbought reading. When it's way below, we get an oversold reading. So according to the rules of the game here, we're going to buy two units when the price crosses above its moving average. And the first signal to sell is when the oscillator crosses its overbought level. That's when we take partial profits. That's when we take one unit off. And then when the price crosses below the moving average, we take the second unit off. And so there's the first unit was taken off there at a high price, and the moving average crossover gives us less profit. It doesn't really matter which one makes more money. The fact is they both made money here. But it could well have been that the price got to an overbought level here when it had taken one unit off, and maybe the moving average was not where it was, and it was going flat along here, and we'd have taken off the other unit down here somewhere. That's one of and this turns out to be a big trading range. That's why we use this approach of the oscillator and the moving average to hedge our bets. So here we have another buy situation over here, and we'd sell the first unit as the price crosses its overbought level. And as I was saying this morning, you could probably use the point where it crossed was above the overbought level and then crosses below it again. That would have been also a legitimate place to have taken off the position. I'm just using it for the sake of this argument as it crosses above the overbought level. And then you sell the second unit much higher because this is basically a trending market. It's not a trading range market as it crosses its moving average. So there's the first unit sold there, and the second unit when it crosses its moving average at a much higher level. So that's one way in which we could combine a moving average and an oscillator. But a better way, I feel, is to use the parabolic curve, which is nothing more really than a glorified type of moving average. Because the parabolic requires two parameters, one that determines the speed of the move, and the other which determines the maximum unit by which it can be increased or decreased. Sounds like a bit of a mouthful, but let's just take a look at the indicator. The parabolic is this blue line, the price is the black line. So that's the parabolic curve just there. And what we see is that, and the way it would work is that you would buy when the price crossed above the parabolic, and you would place your stop normally below where the parabolic starts. So that will be your risk. In this case, it's quite a large risk at the beginning, more risk than I would want to undertake. But you can see what happens is as the price works its way higher, so the parabolic also works its way higher at a faster pace. And that's really when the parabolic comes into its own, after the price builds up some momentum. Because when the price builds up some momentum, that allows the parabolic to come up faster and get closer towards the price. And yet usually when the parabolic is crossed, the price crosses the parabolic relatively close to its final turning point. So that's where the parabolic definitely has an advantage after a move has been underway for some time over the moving average. Because if we look at a moving average, the moving average is probably going to come in like this and cross down here somewhere and then cross up. It's going to be a very slow operating thing. So if when we get our buy signal, or our sell signal I should say, and the sell signal comes from the oscillator crossing the overbought level, then we know that the parabolic is beginning to move up, and we can substitute the parabolic for the moving average. So continuing with this particular chart, then we sell when the price crosses below the parabolic just there. So the stop moves up progressively higher as the parabolic moves up. So because the parabolic becomes a support level, we place the stop below the parabolic on the way up. So here on this next chart we have the price, the moving average, and the parabolic. And because it's kind of confusing here, what I'm going to do is zoom in on the next chart in that little box that I've got just there. And what we can see here is that we have a sell signal as the price crosses the moving average. And we go short at that point there. And then as the oscillator crosses its oversold level, that's where we cover the first unit. So we cover that short position just there. And instead of covering the second position as the price crosses the moving average, we cross it as it crosses the parabolic, because that gives us a more timely signal. And you can see here's the parabolic signal, and see how in this particular example, and it's not always work out as well as this obviously, but you can see that in this particular example, the parabolic gives us a better timing than the moving average. And we do one more, this time on the buy side, in this box here, which I'm now going to zoom in at. And we buy just down here at the moving average as the price crosses above the moving average. And really what we need to do is to use the parabolic as a place of executing the trade when the parabolic crosses above the moving average, because we know that the parabolic most times is going to give us a better timing signal than the moving average. It might also give us more whipsaws too, but generally speaking, it gives us better timing. So we're going to sell the first unit when the oscillator gets into the overbought condition, and the second unit when it crosses the parabolic at that point just there. Had we been using the moving average, we would get out of that second position at a slightly lower level as the price crosses the moving average. So that's a way in which I could like to show you how we combine oscillators and moving averages, and I encourage you to kind of experiment with this kind of approach, because quite clearly the biggest problem a trader has to face is he doesn't or she doesn't know whether we're entering a period of trading range or a trending market, and this is one way to sort of hedge your bets. I'd like to finish with 10 tips to control your emotions. because I think it's important to understand that whenever you commit money to the markets, you're committing emotion. When we're sitting around this afternoon, we're not really committing any emotion, it's all intellectual energy. But when we get out to that marketplace, money gets on the line, emotions come in, and it distorts our judgment. And our judgment, in that case, or emotions go from fear on the one side to greed on the other side. And what we want to do is to, with panic and losses on the one side and overconfidence and losses on the other side. So either side of this extreme is a money-losing proposition. What we want to do is to go straight up the middle with as much objectivity as possible, and that will give us more profits, other things being equal, which they really are. So first thing about controlling emotions is don't trade at the edge of the pendulum. What I mean by this is the pendulum is the pendulum of emotion, and we want to make sure that we're trading in gear with the market emotion, not out of gear. So here we see a chart of Amazon, and the price is down, the news is bad, and the price on this oscillator here is oversold. That's the time when people are tempted to sell and get out. But really that's the time, as I mentioned this morning, when we should be thinking about buying. Emotionally you want to go short, as I say here, but that's the wrong thing to do. We need to look for this as a buying opportunity instead of a selling opportunity. So how do we do this? We wait for the oscillator to reverse direction. In this case here it breaks the downtrend line, not a particularly strong signal, but I'm really trying to emphasize a point here. And the trend line is also broken on the price, so the price is confirming what the oscillator is concerned. So now we're trading at the edge of the pendulum and working on the pendulum in our favor, not shorting at this point, but by going long. So we're following the in-swing of the pendulum here. And then so we buy on the breakout, and you can see the price, this carefully selected example, is going up, and then it reaches overbought again, and it's really too late to buy. So we can't really do anything at this point here in terms of selling. But as the price works its way higher, so you can see the oscillator creates a top, the price creates a top. So this is now becomes the other end of the pendulum and becomes a short selling opportunity. Now the price is declining and down it goes. Not a great decline following the sell signal, but you get the idea about trading with the swing of the pendulum here. Number two is what I humbly call Pring's law. And that is that states that other things being equal, trading success is inversely related to emotional stimulation. And I emphasize other things being equal because sometimes you get very lucky and you're not following the rules and you're not following the right emotions, but you get lucky and you still make money. But other things being equal, generally speaking, if you trade, the more emotion that you put in, the less profits you're going to bring out. And here's an example. You might see this chart here and you see a little breakout take place, so you buy a little bit of the S&P. Not bad, you got a breakout, it's a good idea. Then you see another similar situation, you say, well, I think I'll buy some more because I made money on the last time. And as we move on, you can see, we see a couple more of these obvious instances where these downtrend lines are violated on the upside. So each time you're adding to your position until finally you decide, well, there's another opportunity just here. I think I might just add a little bit more because all this has been successful. And by this time you're getting a little bit greedy. But you're still making money, and it seems to be okay. And then at this point here, you say, okay, well, I got another breakout. I haven't had a breakout for a few bars. This must be a really good breakout because it's had a chance to go sideways here, so I'll really add to my position. See, it's gone sideways here for quite a long period. I'll really add to my position, get really carried away. And it's a breakout, nice breakout. But look at the next bar. It turns out to be an outside bar, which is obviously a bearish sign, especially as it occurs after a breakout. Remember, a lot of these examples I was showing you earlier, we get the breakout and then we get some kind of a negative 1 or 2 price pattern following the breakout, indicating the breakout was a whipsaw, and it gets followed by a pretty sharp decline. Well, guess what? We're right back to square one here. And so getting all these positions here was obviously adding to our emotions because we were getting greedier and greedier and greedier. And our trading success looked assured at this point here, but then by the time we finished, we really ended up with a big loss because remember, all our average price is going to be up here somewhere, not where our first trade took place. Here's the same situation, and if we'd taken a little time to look at some perspective, here's a smooth momentum here, and at the time of the final breakout, at the time of the first breakout, which was just here, it was oversold, but by the time of the last breakout, it was overbought and rolling over. So very important always, I think, to take a step backwards and see what some of these longer-term smooth momentum indicators are doing, because they can add a touch of reality to the trading. Only trade number 3 with a balanced mindset. And here we see the S&P, and it has a head and shoulders top. So naturally we're going to go short, makes sense. And so we get the breakdown, and here's the downside objective. The price goes down more than achieving our downside objective, and we probably get pretty confident at this point here, thinking that we've done the right thing, get a little correction, and then the price is going to go down even further and we'll make even more money. But don't forget that the Head and Shoulders has already met its minimum downside objective, and we've got to be on looking over our shoulder and running scared because we're short. Don't necessarily do that, but the first tip that we're likely to be wrong and not taking all those full profits in the downside objective is when the trend line's violated on the upside, and then you can see there's a small reverse head and shoulders pattern that's taken place. So that would be the signal definitely to get out of the short position and probably to go long, because the reverse head and shoulders has really cancelled out the head and shoulders top. In this case here, it would have been very wise to have got out of that situation. Number 4, patience and discipline are required ingredients for successful trading. And here we see a reverse head and shoulders, and let's suppose we wanted to buy that. Well, we'd probably want to wait for the retracement move to take place if we had some patience and discipline. And in some cases, it just doesn't happen that you get a retracement move. So we have to say to ourselves, well, we've missed that opportunity. It's no good coming in. In this particular case, it would have been okay to have bought further up. But in a majority of cases, you're going to see, or a significant number of cases, you're going to see some kind of a retracement move. And that's the place where we need to have the discipline to come in. If we decide we want to buy this breakout up here, in this case, it did work out fine. But usually it's better to have the patience and discipline to wait for a better opportunity. Because after all, even though this turned out to be a good situation, if we'd got in here, where would we have got out? We'd have had to place the stop down here somewhere. Either at this, we could draw a trend line joining these lows, or we could take it below that low. If we'd got in here, it would have been a pretty tremendous risk. The only place we'd really got in is on that first day when it broke above the neckline there. Then the risk would have been significantly less. Only trade when you feel good and there is an obvious opportunity, never purely because you want to trade. And it goes back to that point I was making before. When you're a trader, become a guerrilla. You decide where you want to fight the battle. Don't let the market decide. You wait for the market to come to you. And when you assess that it's the right time to get into a trade, that's the time to do it, when the odds are in your favor. So here's an example. What we see is the price breaks above this trend line. And let's suppose you say to yourself, wow, I'd like to buy that, but it's gone a bit too far, and I'm really bullish, and I'm really annoyed at myself that I didn't buy on that breakout, and now it's too far to buy. So maybe what happens, this is a 1 minute intraday chart. Maybe it's a daily chart, but in this case, it's a 1 minute chart. So in this case, the time frame is pretty small. So maybe I'll go off and get a cup of coffee and then wait for the retracement to come back. So there's the head and shoulders breakout, and I wait for the retracement. And by the time I come back from my coffee, I've missed the retracement. If I'd been in the right frame of mind, what I would have probably said to myself is, well, I want to buy this situation, and what I'll do, and just in case it pulls back to this extended trend line, I'll buy it in this area here. But because I was so mad and didn't have the right mindset up here, I was so frustrated, I didn't think to do that. So by the time I get back from my cup of coffee, I see the price up here, and out of frustration, what am I going to do? Well, I'm going to buy it anyway, because that's what my emotions are telling me to do. Not what the market's telling me to do, but what my emotions are telling me to do. So I buy at that point just there. And what I say to myself is, okay, what I can do is I can draw a trend line here, and I can place my stop below the trend line. So if the market goes against me, I've got a good place to go out. So that gives me a certain degree of comfort in this situation. So I stop it out below the trend line. Then the price begins to go up, and what happens is some bad news comes out, and the price is now starting to come down. And remember, I'm not really in a good psychological state of mind. I'm not really balanced because I missed the breakout, and I missed the pullback, and I paid a lot more than I expected to pay. So now I see this bad news, so I'm kind of getting a bit nervous. And at the same time, what I can see is the price breaks down from this little rectangle here, and that gets me kind of annoyed and nervous. And I can also see up at the top here that I've got some resistance between this line just here, this point just here, and up there. So not only is it broken down, it's got massive resistance up there. It's not really that massive anyway, but in my state of mind, because I'm not thinking straight, I can see a lot more things that are going wrong in the chart than are going right in the chart. And there's the resistance. But just remember, my original idea was to buy it here, was buying it here, and to wait for the trend line to get violated. But I know better than I'm going to get out right here because the news is bad and I've got all this resistance I'm facing. If I was thinking objectively, I'd say, okay, I've made my plan, I've got to stick to it. But in this case, I'm giving an example of someone who's not really thinking straight, who's emotionally disturbed. And then what happens, of course, as soon as you get out, the price goes up, and you wouldn't have made a terrific killing on the trade, but at least if you'd waited for that trend line break, you'd have made more money than getting out. It's probably a break-even trade by the time you got slippage and brokerage. You would have got out at this point just here. But just think how mad you would have felt when it went up there too, and just after you'd sold it. So one of the things you need to look at is when you buy these things is to see what the oscillator's doing. And in this case here, when it was bought, the oscillator was moderately overbought. So number 6, if you get in for a reason, get out when it's no longer valid. And that, I can't stress that enough. You get in, you get enthusiastic, and then the market goes against you. You really have to get out if the evidence is pointing in the opposite direction. It's okay to stay with the position if it goes up and it starts coming back and the evidence is still pointing to an uptrend. But if the evidence then starts to point to a downtrend, you no longer have a valid reason for staying in that position, and you must get out. Here's an example here where we have a trading range and the price breaks above the trading range. So you buy on the breakout. Where should you place the stop, just in case you're wrong? Well, there's really 3 places on this chart. One is the low, below the low for the trading range. Number 2 is below the previous bar. And number 3 might be if it breaks below the breakout level, which is that green trend line there. Either way, you've made the decision to get out and you placed your stop. And as it turned out, the price did break down, and there was no reason. Once the price had gone below the trend line again, there really was no reason for staying with that trend, because the reason you bought it was the breakout. When you no longer had a breakout, there was no longer any reason to stay in that trade, especially when it went below that low just there. Here's another example that you can see a top in the RSI just here, and you can see the price breaks below this trend line here. So that may have been a good shorting opportunity. And what you can see is that the price works its way higher, and it's not really going through that trend line to any great degree. It's falling below it and finding a little bit of resistance, but it's not really doing much. But it's not enough to change the fact that you're short, and there's not really enough evidence at this point to say that you made a mistake and you need to get out. Except to say that the RSI here breaks above the downtrend line. And remember, when we originally got in, part of the reason we got in was because the RSI had broken below this trend line here. So in other words, what the RSI, and it was in a downtrend, didn't go very far, now it's broken out and it's now in an uptrend. So now the situation begins to change a little bit, because the momentum was negative, and that was one of your reasons for getting in, and now the momentum's positive. The price had broken below the trend line just here. That was a reason for getting in. and it's still hugging the trend line, but now the price is back above the trend line. So really, there's not the same reason, that you don't have the same rationale for being in the trade. So really, at that point, you should get out. Maybe you're going to be proven right and the price does go down, but the odds are no longer in your favor. And being good guerrilla warfare type fighters, it's probably a good idea to get out because the probabilities are not with you. Emotionally, it's difficult to get out because you were with the trade and you expected to make some money. Now maybe you're going to make a small loss, you're going to break even. But that is the time when you really have to step up and say, okay, I've got to get out of this thing. You've got to take the emotion out of it and say, would I get into it right now on a short side with that evidence? The obvious answer is no, because you're above the brown trend line and you're above the green trend line on the rate of change, on the RSI. So there really is no reason coming into that situation on a fresh basis why you should be in it. The only reason you might stay in it is because you're already in it, and psychologically you're attached to it. You've got to get rid of that psychological attachment and get out. And in this case here, what happens is you can draw a downtrend line on the price. Now we have a breakout from the price on the downtrend line, which is confirming what's going on with the RSI. So if anything, we need to go long this situation, not short. And what we see happening, and we can take away that brown line, that was quite clever. And what happens now is the price comes up and it gets into, I believe, a trading range. Yes, it gets into a trading range. And we might want to short this trading range because the oscillator has now given us a sell signal by crossing below the overbought level. So if we do short this December corn, we then decide where we're going to get out of it if we're wrong, and that will be above resistance, and so that will be above the upper line. And in this case here, that would have been a good place to stop because the price literally exploded above that trading range, even though the oscillator suggested it was going down. What we really should have done was waited for the oscillator to give us a sell signal, which we did, and then waited for the trading range to be resolved on the downside. It would have been no good buying for the upside because by the time it broke above, the oscillator was in an overbought situation, so the odds wouldn't have been in our favor, so we wouldn't have gone with the trade. Number 7 is don't penny pinch. Here's an example of a price pattern. We can take the price objective and we can move up to the price objective, and we can see that the price objective was almost achieved. The problem is that we have an outside day forming just there. So at the end of the outside day, or outside bar I should say, it's a 5-minute bar, at the end of the outside bar, the chances are that we're going to go down for the next 5 to 10 bars. And we've already almost achieved the price objective. So the point here is then we should have perhaps taken profits, but we didn't know it was going to reach the price objective. But now the indications are that we've got the breakout on the upside, and now we've got the outside bar. Probably going to take prices down for 4, 5, 10 sessions, next 50 minutes because it's a 5-minute bar. So probably the best thing to do in this situation is not to penny pinch and wait for that extra rally towards the objective area, but just to get out. And in this particular case, that proved to be the case. Here's another example here where we see a head and shoulders top, but I've put a question mark by the right shoulder because the question is that top going to be completed? And maybe we're in a bull market, and you've decided we're in a bull market because you're looking at long-term indicators, maybe it's above its long-term moving averages and so on and so forth. The momentum, smooth momentum is very positive. And so what we see at the bottom of the chart here is an oversold situation. Remember what I was saying this morning, when we get a bull market, we get an oversold situation, the price is extremely sensitive to that oversold situation, and it's probably going to rally. So maybe you say to yourself, this head and shoulders is not going to work, and I'd better get on board this thing because it's oversold in a bull trend, and we're going to see an explosive rally. But what I'll do is I'll wait for it to touch the neckline because I know that's support, and that's a good price to buy it at. So in other words, it's down here, and that's where it has to go below that trend line, or at that trend line, and that would be a great place to buy. Well, really, there isn't much difference between the price where it is now and that potential neckline. So why not just buy it there? Why do you have to wait for it to go down to that trend line? Why penny pinch? Why not get it in there? Because if you're wrong, you're not going to lose much more. But if you're right, you've got a huge potential reward because that's a head and shoulders pattern that could fail. Well, the next chart shows you the thing in perspective. And you can see that it never actually broke below that trend line. There was the oversold condition. And if you had waited for it to hit the neckline, penny pinched, as you might say, you wouldn't have been able to get into that situation, and you would have lost on a particularly good, profitable trade. Number 8 is trade smaller positions when things go wrong. When things go wrong, you're depressed, you're not emotionally stable, and consequently, if you're trading large positions, you're going to think that every tick, every penny in that market makes is greatly exaggerated, far more exaggerated than it is. So you've got to get that strong emotion out of your trading, and the way to do that is to either get out completely until you feel a lot more stable and a lot more emotionally objective, or if you really feel you've got to trade, then get down to a much, much smaller position so that it's not going to be, when it goes against you, it's not going to be magnified like it will if you have a large position. Number 9, not sure, don't trade. Remember the probabilities. And here we see a situation where we see a double breakout. Looks pretty good on that chart, but we've got to remember the probabilities. And what are the probabilities? Well, here's the chart in greater perspective. And we've got 2 indicators, a 14-bar RSI and a smooth momentum indicator, what I call a KST. And the idea here is you're getting the breakout taking place, the double breakout, which looked good when you were looking at the first chart, but you can see that it's occurring at a time when just prior to the point where the momentum, the RSI, had violated an uptrend line. So this is more of a point just here where you should be thinking of selling rather than buying, and yet you have a breakout. So the probabilities at this point are not necessarily in your favor. The second thing is that as the breakout's taking place, so the KST is overbought and starting to roll over. And in this particular case, you can see that it broke down to the downside, and that was a false breakout. And the other point here is that at the time of the breakout, what was happening is that the RSI was once again moving into an overbought condition at the point where this trend line, this extended trend line, was being plotted on the chart. So you're at resistance here at a time on the RSI, and an overbought resistance at the time of the breakout. So again, you've got to think of the probabilities, not just look at the charts, you've got to look at the other indicators and see what they're saying, because they'll give you a much fuller picture of what's going on. The situation here, we see a successful test of the low at that point just there, and we rally up to new highs, so we're going to have a series of rising peaks and troughs. We also have a declining trend line here, and we can also put in a reverse head and shoulders. So in this particular instance, we've got a lot of chart action that suggests that the market's moving higher, in this case the NYSE composite. And if we look at the RSI, at the price, we can see it's already broken the downtrend line as we saw before. The RSI has broken above a downtrend line, and the KST has crossed its moving average, indicating prices are likely to move higher. So in this situation, all the ducks were in line. It was a good situation. The price was giving you lots of indications that it was going up. The RSI was as well, and so was the smooth KST. So in this case here, you're not having a conflict between what the price is doing and what the momentum is doing. So the odds and the probabilities are in your favor. This case here, we can see new highs, which means rising peaks and troughs. See a breakout in the 14-period RSI and a trend line break in the price. Question is, will the KST turn bullish? Well, you may decide, okay, on the basis of the RSI breaking above its trend line and the price breaking above its trend line, that's enough evidence for me to get into this situation. But just in case you're wrong, you have to decide, first of all, where it is you're going to get out. And the chances are you would use this trend line joining these two lows. So you place your stop below the two lows, below that trend line, that support level, just in case things went wrong. So here we have the same chart, but now we can uncover a little bit more. And you can see in this particular case that the KST never went positive and the price broke below that support level. So you would have got out with a small loss. And this next chart shows you exactly where you were. if you had got in, you would have been in this trading range here, and you would have got out just before the final break in the market there. The point being that it's often a good idea to look up at the next trend to get some kind of a feeling for what the overall environment is. In this case, the overall environment, even though the microenvironment looked reasonably positive, the overall environment was one of a sharp and persistent downtrend. That's this period from here all the way down to there. So always when you're trading, look up at the next trend level to see exactly what's going on. And finally, number 10, take your time to learn. My point here being that if you want to go and play golf, you may have a few lessons, but are you going to go and play against a pro? Well, if you have a few lessons in technical analysis, that's exactly what you're doing. You need to take time to learn and act slowly and build up your skills over a long period of time, because as soon as you get in that marketplace, you're playing with a lot of people in the financial districts in London and in New York who are professionals who have one thing in mind, and that's to take your money. With that pleasant thought, I'll close. Thank you.
Okay, on behalf of everybody, we'll give Martin a round of applause.
Thank you.
I can't thank you enough. I say Martin's shooting back to Florida. He has a plane to catch, but as I say, he's been very generous with his time. We're going to take 20-25 minutes break, so it's 4:15 now. If we can be back in about 20-25 minutes, we'll do the final presentation. We're going to look at OmniTrader with Chris Byers, and I'm going to go through the website with you and give you some final tips to put this all together. So 20-minute break, back as quick as you can, and we'll get off again. Thank you.